Hi, I'm Stan Barnes with Barnes Capital Group, and we're here today with Milt Williams, who's with Infinity Funds out of Atlanta, Georgia. And just wanted to chat with Milt a little bit about what Infinity Funds, how they manage money, and how they might fit with your portfolio planning. So Milt, would just, if you could, just tell us a little bit about Infinity Funds, how long you've been around,
Sure.
What type of investors you have, and what
Sure.
you do.
Yeah, we Infinity Capital Partners was started January of 2002 as an alternative investment firm. We're based in Atlanta, Georgia. We manage what in the industry is referred to as a fund of hedge funds. So we invest our clients' capital in a diversified basket of hedge funds. Our clients tend to be primarily high net worth individuals, so probably about 75% of our assets are high net worth individuals, and of that 75%, close to 100% of those come through investment advisors such as yourself, and the remaining 25% is primarily made up of endowments, foundations, some pension funds. We're sort of expanding into that. We're managing approximately $500 million in AUM at this point, which we're at peak assets. 9 employees in the firm. The partners own the firms. We're employee owned. It's kind of the base case.
Okay, great. Well, obviously, here the first part of 2016, markets have been kind of crazy, pretty volatile. What are y'all's reads on what's going on, or is the end in sight?
I don't believe the end is in sight. There has been a lot of volatility. It sort of began to pick up in the fourth quarter of last year, and it's it's really come on strong in 2016. Right now we're kind of seeing sort of consensus build around the idea that China is a driver of this. I think there's a lot of concern around China. I think there's that's sort of a point of interest to everybody that's in the markets is what's going to happen, with China and their sort of the yuan and maybe a possible, increased, pace of devaluation there that's sort of going to export recession into emerging market countries, and that's sort of I think something that people are pointing to as far as volatility goes. The other sort of point that I think everybody's focused on right now is energy prices, and sort of commodities in general. But energy has really been the thing that's gotten a lot of people stirred up. It's created a lot of I think wreckage in the market. And then for us, we really look to central bank policy, and I think that's both a opportunity and maybe a threat. You've got the Japanese central bank, kind of beginning to start, trying to sort of experiment with negative interest rates. You've got the ECB trying to sort of manage their sort of quantitative easing. The banks are really getting hit in Europe right now, and they're trying to figure out how to help them. But here in the States, obviously we've raised rates, and
right.
And that's obviously created some volatility.
Finally.
Yeah, finally, sort of begin this, this long process, and see if they can sort of slowly walk them back up. But I don't think anybody out there thinks they'll see another rate increase this year. So maybe we get, do we get 25 basis points, in 2017 at some point? But it's going to be a long, slow crawl out of the ditch, if you will.
Well, the themes that you mentioned obviously are a little scary, potentially, but I mean, there is a silver lining out there. I mean, there is good news that it seems to me is kind of getting overlooked about what's going on in the United States.
Yeah, I mean, I agree with that, and we see a lot of we're seeing a lot of data and a lot of color around this concept that X energy, the U.S. domestic market doesn't look too bad. I mean, companies tend to, the balance sheets look okay. They've got high levels of cash and reasonable levels of debt, and if you back energy out, the market. I mean, not necessarily the market, but the data doesn't look too shabby. It's not robust growth, but it's not a recession either.
But I mean, we're kind of in the earnings season where companies are reporting for the end of the year, and I heard the statistic that 70% of the companies that are reported have beat estimates.
Yeah.
So we had great job growth last year. We had great auto sales last year, and so it may not be robust recovery, but we are clawing our way back and moving in a positive direction. And I just think that gets kind of buried with all the negativity that you hear, in the publications and CNBC and other.
I tend to agree with that. And I think some of it is, like I've said, it's animal spirits in a way. I mean, the market's been moving up for 6 years roughly,
right.
At a fairly steady clip, and at some point, it gets high enough, valuations get pushed up far enough, and if people, in fact, I'm almost in a way they're subconsciously looking for a reason to maybe trim positions or get out, and then that when some start to do so, then it sort of triggers other people to do so, and you get these pullbacks in the market, which I don't necessarily think is a bad thing to have this happen. I think we're gonna be in a period of increased volatility, with this sort of divergence in central bank policy, which is I think where something like what we do comes into an investor's portfolio. I think when investors kind of look out into the world and say, hey, if I'm going to be in this period of greater volatility, and I'm at an age where I don't necessarily know how much risk I'm willing to sort of take into my portfolio, that's kind of why we're here. What we do at Infinity, which is to try to offer something that sort of helps, bring absolute return into the portfolio, something that's maybe going to damp down the volatility of a client's portfolio. And hedge funds over the years have proven to be effective tools to do that.
Well, and that's the Infinity would be classified as a alternative investment, as opposed to a core equity fund or something of that sort. And so I guess part of the objective there is to have an investment that's not going to be directly correlated to the broader market.
Exactly.
And you all, depending on, you have several products that you offer, and but typically you've got somewhere between 9 to 11 maybe.
Yes. Different
managers with different strategies within that fund, which I think characteristically that's a lot smaller stable of managers than the typical fund of hedge funds. Yeah. Which to me is a good thing. I mean, you can monitor and measure them a lot more closely. And y'all actually, Jeff Vail, who is your CIO, actually goes on site and meets with these guys on a very regular basis. Talk a little bit about your due diligence and how you monitor that.
Sure. I think you brought up a lot of interesting points. We take, I think, a somewhat different approach than some fund of funds do. We have tried to simplify sort of our the quantitative screening side of it. I think every fund of funds that's out there has, there's 10,000 hedge funds that are, that's an estimate, 10,000 hedge funds that exist. It's a lot of data to comb through.
Right.
And, the data tends to be hard to compile, and, there's so many variables in these strategies that it's difficult to make true sort of apples to apples comparisons between managers. So, I think for an individual investor, it's a very daunting task to try to sort of figure out how to, hey, I want to put this in the portfolio, but how am I going to do it? And, we've tried to simplify that process at the top. Our products, we're really only focused on managers with 10-year track records, 10 billion or more in AUM. And then we like the managers themselves to have a multi-strategy approach, meaning that the managers are running multiple different types of strategies internally. We also look for managers that have a very low net exposure, and for a lot of investors that have been used to investing, just buying stocks long or buying bonds, the idea with low nets is that you'll have a long position here, and you'll also have a counteracting short position. So when you hear people in the hedge fund industry talk about net exposure, if you were 0% net exposure, basically you've got 100% net long and 100% net short in your, which is kind of the goal we feel like is the goal for us, to try to tampen down volatility. Mm-hmm. So we're running, right now on an aggregate basis, and we have software that we can pull in all the position level detail from all of our managers, push it up, and we can see, sectors, we can see geographic regions, we can look through a lot of interesting data points. But one of the things we pay a lot of attention to is what is our overall portfolio sort of net exposure. We want to see that, sub 10% net long. We really don't want to be, to have a lot of exposure just long the market. We feel like you can get long that market exposure much cheaper than you can with someone like us, and we really want to be sort of a balancing agent there. But that's kind of our, I think, sort of philosophical take, is that we don't want to, we want to hold a smaller number of managers, because we really feel like one of our, sort of great sort of value adds to the client is that we do a tremendous amount of communication. We probably visit the managers on every 45-day basis and on site, and then we probably talk to them on a weekly basis, and if the market conditions dictate, on a daily basis.
Right.
And the way our business model is built, it's kind of, I mentioned, most of our clients are high net worth individuals, but we sort of relate to them through the advisor. And so, we spend a lot of time trying to create data and push it down to the advisor, so the advisor has, a very what I would consider robust sort of context around what's happening with the managers.
Well, I know one of the appealing things to me about working with you guys is your accessibility, and the fact that you are located in Atlanta, and that we can go up and kick the tires and meet your personnel. And we've been working together now, I think, at least maybe 7 or 8 years, and I can remember back in 2008, 2009, when the market was melting down, I actually could get you on the phone and you would answer it and talk to me and let me know kind of what was going on. And that's really meaningful, when I've got to answer to clients, particularly in the most stressful of times.
I was telling someone the other day that I had one of my memories of 2008 is having a sore throat for like 3 months because I literally would talk on the phone for 12 hours a day.
Right.
But yeah, absolutely. I mean, that's when we were sort of building the business and sort of feeling our way along and trying to figure it out. The registered investment advisors, the guys like you guys, were really kind of where we started to raise assets and work with early on. And I think we've tried to sort of grow our business, and as we've grown it, to understand the way you guys work. And we always felt like that was sort of one of the missing pieces in the fund of funds or the alternative space, is this sort of what I would consider this sort of last mile disconnect between the managers that we invest in and then us and then you guys. And so I think for us it's sort of been a key component to the way we built it. And I'll tell people that all the time. I think our value add in the process is I think we do great fundamental research on the managers that we invest in, and I think we do great communication, and that's to us are sort of the key tenets of the business, is to try to be as open and to create sort of that. I think one issue that a lot of investors have had with fund of funds over the years is I think conceptually they understand this, so I'm going to buy this. It's a portfolio of hedge funds. But then 6 months go down the line and they see something in the journal and they see something on CNBC, and they go, well, gosh, I'm hedge funds, and there's news here, and then they call their advisor up and say, I know I've got some, but what is it? And that's where there's sort of a breakdown, and we want the advisor to be sort of very empowered and to be able to talk through the portfolio and understand, so it's been a key driver to our business.
Right. Well, listen, I just wanted to thank you for coming in and spending some time with us today, and obviously for the clients out there or prospects out there, if you would like additional information, please give us a call at Barnes Capital Group, and have a good day.
Thank you.